Welcome to FX Options University, recorded live at the International Securities Exchange, the world's largest equity options exchange. Join the industry's top trading professionals as they provide insight and strategies for trading in the currency markets using FX options. FX options are a low-risk alternative to hedging currency moves in any market condition.
So what I want to look at here is we also have to consider the delta of the net position as well. And the delta of the option contract refers to how much an option premium will increase with every 1 point move in the underlying security. So what happens is when we create a spread, we actually lower the net delta as well. So what happens is the spread will not profit as typically expected with the move in the underlying pair value. And what I mean by that, if we take a look at the EUI once again, you'll see that the put option, and incidentally, the put option deltas are always going to be negative. But this is suggesting that for every 1 point drop in the EUI, our put option should increase 40 cents, so almost 41 cents. Now, that would be all ours to keep if we just simply had that put option. But if you take a look at the 72.5 put, you'll recognize that the delta down there is actually 20.21. So what we've done is we've offset the net delta to a point where that move is only going to net us a 20-cent profit on the position. So what I run into quite often, again, are people take advantage of the spread strategy. Then they get a really quick move in the underlying security, the underlying pair value, and they cannot understand why they're not profiting as much. Well, we have to understand that anytime we create these spreads, all of the different variables are seeking to offset one another, which in the very sort of principles behind utilizing a spread, that's what we're after. The focus is trying to offset an expensive option contract, in which case we're creating that volatility neutral strategy. But that comes with cost, and that means that we cannot expect the underlying the spread benefit as significantly as if we were just holding the put or call option on its own. So in this case, the short option delta reduces the influence of the move. Instead of a 40.67, the influence of a 1 point change in value is 20.46. And again, we have to note that a long put has a negative delta, and of course a long call has a positive delta. So as a result, a debit spread will not reach its full potential until expiration. This is something that we have to recognize. It is inevitable. It is as good as written in stone that you will not recognize the full potential of your spread strategy unless you hold it until expiration. Okay? And this will only occur if the underlying pair value is at the written strike or in the money. Okay? The reason is that at that point, all of the time value will have disappeared. All of the implied volatility premium that was factored into the option contract will have disappeared, and you will only be left with the intrinsic value of your long call option, and then of course, or your long put option, and then of course, when you subtract the intrinsic value out of your short call or your short put, then that's going to leave you with that spread differential that you created, and your profits are, of course, the spread minus the premium that you paid. So we have to understand that we can close the spread out at any time before expiration. And a lot of times, individuals will say, well, oh, you know what, I want to keep holding this. I want to, I'm not going to recognize my full profit until expiration, so I want to hold it as long as I can. We have to understand that the spread strategy is still subjected to that directional bias. So, in other words, if we have that put spread in place, and for the first couple of weeks of the spread, the underlying security is going down in our favor and we're making money, we have to understand that as soon as that underlying pair value turns around and goes against us, we're going to start losing on that spread as well. And so we want to make sure that we're managing to lock in profits, not so much looking to capture that full benefit of the spread. Now, there are certain considerations that we can make. In the event that, let's say, the pair value has significantly exceeded our written strike, well, that simply means that we have time to sit back and wait for time to pass by, and we have to understand that every dollar or every pointed intrinsic value that an in-the-money option contract generates, that actually offsets the risk of or the depreciation of time value. So the way that this spread works is that the more intrinsic value our long call or our long put generates, the less influence it is on the less it's influenced on a day-to-day basis on that passage of time. But of course, the written strike, ideally, is still out of the money or just simply at the money, so that rate of time depreciation accelerates. So what we say is that you do have to give these spreads time to widen out, but understand that you will never recognize your full profit until the actual expiration date is upon us. And remember, of course, that these ISE FX options are all cash settled in U.S. dollars, so we don't have to worry about taking on any sort of underlying security. The spread will be settled out for the difference between the strike we bought and the strike we sold. Okay? So just to summarize this here before we take a few more questions, the benefit of a debit spread is that it's going to reduce the break-even point of our trade, which allows us to profit sooner. It's also going to reduce the potential loss if the pair moves adversely, but we do, of course, lose upside potential beyond the sold strike, so that has to be a trade-off that we're prepared to take. And of course, finally, if you want any more information on this or any of the other strategies, or if you want to review some of the other webinars that are posted as recordings, you can simply visit www.fxoptions.com, and you'll find a wealth of tools there. It's a fantastic site. If you want a little bit more insight into the dynamics of this particular market and how you could bring them into your portfolio to trade your currency views, this is a fantastic site to do so. So on that note, I'm happy to take any questions as it sits right now. I haven't really been seeing any questions rolling into the chat box. So Lauren, I'm not sure if so it looks like you're more or less having to send them over my way. So the one question that just came in is, are the puts American or European style exercise? So we have to understand that there is no deliverable for these particular options. So what that means is nobody is going to exercise their right and force you to deliver anything before that expiration date. European style exercise, which is essentially what these options are, means that they are not exercisable until expiration. And again, because there is no underlying security to change hands, the positions are simply cash settled in U.S. dollars. Okay? And that goes for both calls and puts. Again, cash settled in U.S. dollars. So you can write puts, and you understand that you cannot be forced to cover that position by anybody else other than you just following a risk management protocol that you set out for yourself in the event that you find yourself on the wrong side of it. But you can hold an in-the-money written put option, or you can have an in-the-money written put option out there until expiration, and at the time of expiration, it will only be cash settled for the loss, which at a loss, which is the difference between the put you've written and and of course the settlement rate, such as it is on that particular expiration date. Any other questions, folks, as we wrap things up here today? I think I may have. So another question, are there weeklies or monthlies only? So at this point, we're looking at monthly expiration, monthly expiring option contracts Now I'm not sure what the ISE has in the works at this point. They're always coming up with some great, fantastic new products to trade. So that would be something that you might want to, a question you might want to pose to the folks at the exchange. But as it stands right now, we're looking at just monthly expiring option contracts for us to utilize.
All right, well, it looks like there's no more questions. So, Jason, we just wanted to thank you again for presenting today, and thank you to everybody else for coming today. If you do have any questions after the webinar, you can feel free to email us at webinars@ise.com. Actually, Jason, I see one more question that's coming. I don't know if you want to grab that one.
Yeah, so it's actually, I believe I answered that already. The question is, are these European contracts? Yes, they are European-style exercise, which means quite simply that if you are somebody that is writing the option contracts, you don't have to worry about being assigned on that written contract. They are not settled until the expiration date, in which case they are cash settled for the difference between the strike price and the settlement value of the particular currency pair based on the spot market rate at noon on the Friday. So it actually becomes a very, very powerful market to trade, or a very, very powerful product to trade, again, because you don't have to worry about getting assigned if you are the options writer. So they and then no worries, but they are European style exercise, cash settled for the difference.
Great. Well,
okay, so
if
there aren't any other questions, I just wanted to thank everybody for joining this evening. Sorry about the little technical difficulty at the beginning of the session. Hopefully you guys have found this informative. And make sure that you check out the fxoptions.com site for the next upcoming webinar. And of course, if you want any more information about us and what we do, please visit optionsource.net. So thanks, folks, and thanks again to the ISE for bringing me on board today. Bye for now.
Great. Thanks again. Bye-bye.
Thank you for participating in this week's session. Please join us again next week. Get trading ideas, exchange rates, webinars, news, and commentary. Visit www.fxoptions.com. ISE FX Options can be easily traded through all options-enabled brokerage accounts. These exchange-listed securities are cash-settled in U.S. dollars and have a European-style exercise.